Hi, good afternoon, everyone. My name is Eric Anderson. I'm the Chief Technology Officer at SynMax. I want to thank you for taking time out of your afternoon to attend our webinar. We're going to be talking about our new Excel add-in. It's a very exciting time for us. The Excel add-in has been long in development. I, for one, believed for a very long time that I was going to be the one to convert the energy trading industry over to Python. But today, I admit defeat in that effort. So, without further ado, let me share my screen. And show you our add-in. One second. There we go. After you download and install the add-in, it's going to show up here on the top of the toolbar in Excel. And the very first thing you're going to want to do is click the Authenticate button. A window is going to pop up where you will enter your API key. If you don't have your API key, you can email me or our support group, support@synmax.com, and we will send that to you. There's many different ways and many different data sets to access here, so I'm going to go through a couple of the popular ones. The first one, very much like the Bloomberg add-in, you can simply type equals into any cell, and then the letters SMX. Once you do that, a list of all available data sets, which are the same data sets that you can get through our API or through Snowflake or through our portal, is going to populate. Rigs, frac crews, short-term, long-term forecast, forecast progression, all the production data, and all the pipe scrape data is available. You can also use the formula builder, which is built into Excel, by selecting one of these data sets. Let's do rigs, and then clicking this FX button. The fields that can be populated allow you to do any of the same filters which you're familiar with. And in this case, I'm going to do Louisiana, and I'm going to do since the beginning of the year. You can see it pulls in the data pretty quickly, 6,000 records, and it pulls it in its most granular form. What does that mean? It means that for every day, for every rig, you get one data point. So that's the Excel way of pulling it in using the Excel formula builder. Let me show you the preferred way, which is after you've selected SynMax Energy to click on this formula builder button in the top left corner. Let's select the same data set, rigs. And now, instead of having to enter the state code and the date, I can select them from a dropdown, which helps with formatting issues. I'm going to do the same thing, pull the exact same data set, January 1. And in about the same amount of time, the approximately 6,000 rows are loaded. Let's say I don't want the most granular data set. Let's say that I want an aggregated data set. Well, I can do that too. First way that I might do that is by selecting the data and inserting a pivot table. But with the formula builder, that is not necessary. We can do the aggregation for you. This helps particularly with very large data sets. Our production data set, which is production by well, is over 300 million rows, certainly larger than anything you could fit into Excel. And so you can tell our system to aggregate the data before it sends it to you. So I'm going to do the same thing, except I'm going to aggregate the rigs data set by state code. I'm going to filter on Louisiana, and I'm going to select the same start date. Now, instead of getting the most granular data set, you can see it much more quickly pulls in the aggregated data set. which is the number of rigs per day in the state of Louisiana. I don't need to create a pivot table. I can just immediately create a graph out of that. All right, let's look at a couple of different charts that I've gotten a lot of questions about and how you would construct them in Excel. So the first one a lot of people like to look at is the public versus private chart. This is a chart that we've highlighted many times in our research reports and we've talked about on other webinars because it's important to understand the difference between public and private producers. And a lot of people are wondering how we're generating that data. Well, you can do it with our Excel add-in pretty easily. So I'm going to go over to the formula builder. The first piece of information I'm going to pull in is the rigs data set again. I could also do this with frac crews. I could do it with completions. I could do it with production, but let's keep it consistent and stay with the rigs. And instead of aggregating by state code like I did last time, I'm going to aggregate by operator this time. So it's going to give me the count of all the rigs by operator. And I'll do the same thing as before. I'm going to go back to January 1 and pull that data in. All right, about 34,000 rows, a little bit of a bigger data set. But you can see it still pulls it in relatively easily in less than 15 seconds or so. But I need to grab one more data set. So I'm going to pull in the operator classification data set. That is essentially a lookup table. It tells me for each operator whether they are public or private. And if they are public, it gives me their ticker symbol. So I'm going to add a new column up here called type, and I'm going to use a VLOOKUP on the operator column, pulling off of this table. You can see my first value comes in as NA, and that's because for this date, there were operators, well, there weren't any, there were 0 rigs that had no operator column. So to solve for that, I'm going to use an Excel formula's favorite cheat, which is if error, which means if it's not in the lookup table for any reason, and we like to keep this table updated, but occasionally there are new operators that come in, it is most likely a private operator. Copy that down. You can see public, private. We now have our data set. So now I'm going to create a pivot table out of that. My columns are going to be the type, and in the middle I'm going to put the sum of the count of rigs. Use a stacked area chart, and you should see a familiar chart, one that we've highlighted many times in our research, which is the breakout of public versus private rigs. Something very important to watch, not just the rigs with the frac crews, as the two groups tend to operate distinctly from one another. All right, one more chart type. This one is going to be a composite chart. So it's going to require a few queries, but there's a lot of good data sets in there, and it'll give you a lot of information about what you can pull in with the Excel add-in. So the first one I'm going to pull in is our daily production model. Use Formula Builder for that. The daily production model gets updated every day. It is an estimate of dry natural gas production by region based on the pipe scrape data. So I'm going to aggregate this by subregion. I'm going to select one of my favorite regions, Permian, New Mexico. A lot of interesting things happening in Permian, New Mexico. I'm going to take it back a little bit further than my previous queries. I'm going to go back to the beginning of last year. Okay, so now I have the dry gas production starting at about 4.5 BCF beginning of last year, trending up towards 5.25 BCF as of this morning. I'm going to pull in a couple of extra fields. I'm also going to look at our forecast. I'm going to graph this against our forecast, see how well it's performing, see what we expect to happen in the future. So let me pull the forecast time series in. And in this case, it is the long-term forecast. And then one last data set I want to look at, I'm going to pull in the frac crews. I'm going to try and see if there's any relationship between production, the forecast, and the frac crews operating in that region. So for this, I'm going to aggregate by subregion. I'm going to select Permian, New Mexico. Again, the formula builder is great because I can just select the dropdown. And I'm going to pick the same start date, of course. Jan 1 of last year. You can see it pretty quickly pulls in all the data. Now, if I want to graph all this together, I've got to create a table. So let's have a column called date. And for date, I think I can just recycle these dates from the daily production forecast. But I do have a forecast in here, so I want to carry it out into the future. So I select the two bottom cells, and let's take it out to October of 2023, so you can see what that forecast is looking like. Okay, for my first time series is going to be dry gas. You look up on that. Next, I want to pull the forecast in. Some ifs for this. I'm going over to the forecast table. And I want to select the correct date. I want to select the correct region, which is Permian, New Mexico. You'll notice it's 0. That's because it's the beginning of 2022. It's before we started our forecast. But if you go to the bottom, oh, I see what happened here. The forecasts is a monthly data set, whereas we're on a daily. Easy to fix. We just add a monthly column. So we'll say equals date. The year is the same. The month is the same, but the day is always set to 1. Then we just change our formula onto that column. And now we get the forecast plotting on a monthly cadence with the daily data. And then the very last data set I wanted to include was the frac count. This one's simple, just a VLOOKUP because we've already aggregated the frac count. We don't have to do anything else, just VLOOKUP on the date. Into the frac crews. Copy that down, and we are ready to graph this. Obviously, the scales of this data is very different. BCF a day is different from raw frac crews. So let's move the frac crews over to the secondary access. Now we've got a more interesting graph. So the first thing I want to point out, obviously, the long-term forecast is not 0. It's simply a null value. If I wanted to, I could add an if statement into forecast here, which say basically if it's equal to 0, then put it NA, and then it wouldn't graph it on here, and you'd have a much cleaner graph. But I think the story being told here is essentially the same. The beginning of 2022, production in Permian, New Mexico was just barely above 4 BCF a day. Over the course of the year, it trended up fairly substantially, all the way up, ending the year at a high of 6 BCF a day. And if you look at the frac crews tell a very similar story, but in a forward-looking sense, right? So the frac crews start low, and then the frac crews peak. So we have a huge growth from about 30 frac crews up to 50 frac crews operating in that region. And it seems to precede the production story by about 60 days, which is very consistent with what we've observed. From the time a frac crew shows up on the well to the time the well hits the pipe, the rule of thumb is it's about 60 days. So we should expect to see a relationship between these two lines offset by 60 days. And that's exactly what we're seeing here. So if you were modeling out Permian production on the New Mexico side through the end of the year, right, you would have seen this 2 BCF a day growth. Without understanding what then happened to frac crews, it would have been very difficult for you to call this as the peak of production, right? But with the frac crew data, and we saw a very precipitous drop in frac crew shortly after that, back down to the 30, 25, 30 crew level, right? It was then easy for us to construct our forecast, which is this orange line, that correctly called the peak of Permian, New Mexico production. Now, of course, it's not the peak if they set a new peak later, but so far the frac crews have not shown up. So our forecast is currently expecting it, maybe to get a little bit stronger towards the end of the year when the prices improve, but continue declining in the meantime. And you can see we're very proud of that forecast. Would love to take full credit for it, but really the frac crew data makes it easy. Frac crews, what production is going to do in advance. All right, so that is our show. I hope you learned something about the SynMax Excel add-in. If you have any questions, please email us, support@synmax.com. Thank you very much.